media in 20 Asian countries. So we would like to welcome you today to the landmark webinar Clubhouse session on the rise of Govcoin and what's next for crypto. So the interest in both topic is immense. So we have seen like a lot of trend regarding governmental coin and digital asset as well. So the webinar has attracted more than 220 attendees from across Asia and North America, and I think from various other countries as well. So the word rise is often synonymous with to a great big thing, whether it's an empire like the Roman or closer to our time, the much referred to the rise of China and the rise of Govcoin or central bank digital currency is a seismic shift on a global scale. So this innovation by state nation is a result of the tech disruption, which continue to accelerate and revolutionize what we know about money at the moment. So all in a while, this unstoppable and as innovative as per private fintech sector appear to be heading toward a shakeup on a global scale as the decentralized finance and crypto demonstrate their staying in power as well. So on behalf of the Star Media Group, Malaysia, Korea Herald, the investor, both of which are member of the Asia News Network, we are honored that many distinguished speakers are able to join us today and to share with us their insight, experience, and even look into the crystal ball and what lies ahead. So we are delighted to report that Professor Tonya, even from Penn State, Dickinson Law faculty and founder of Advantage Events Academy, Philadelphia, is able to join us as well in the last moment. She'll add to our understanding on the legal implication of new technology and innovation. So may I please briefly introduce a speaker on other speaker in the first session as well on the rise of Govcoin. We start with Mr. John Kiff. He is the former senior financial sector expert at the International Monetary Fund or IMF and has an exceptional overview on the global digital currency landscape. Next, we have Mr. Nelson Chow, the CFO Hong Kong Monetary Authority, Central Bank from Hong Kong, China and UAE are exploring a digital currency cross payment project together as well, from my understanding. And last but not least, we have Andrew Ching, who is one of the Asia eminent economists from Malaysia and columnist from the Star and Asia News Network as well. And in the second session, which will start by 11 a.m. or 10 a.m. is it? I'm not too sure. I think 11 a.m. right? The second session.
10 o'clock Bangkok time.
10 o'clock.
11.
Oh, sorry. Yeah. So we'll have Professor Kevin Werbach from Wharton School, University of Pennsylvania, where he presently is there, right? Professor of Legal Study and Business Ethics. And then we'll have Mr. Stephane, founder and president of US-based Elevated Return with a business focus in Asia. And Marcus Lim as well, Group CEO and co-founder of Zipmex, a regional crypto trading platform. And Professor Tonya Ewan as well. And last but not least, we'll have Mr. Pindar Wong as well, chairman of VeriFi, a prominent financial blockchain technologist from Hong Kong. So I'll hand over to Pana to start moderating with the first session.
Thank you very much. I also mention that the Wharton's Alumni Association of Thailand are also participating. They have many of Professor Werbach's students here to listen to him. And okay. Perhaps I could go to John Keefe first, and then he will give us an overview on the global digital currency landscape. Please, John.
Thanks, Pana. Let me just get my screen share up here. All right. So I'm going to give you a little introduction to the world of central bank digital currency. I've been involved in this field going back to, well, these are two IMF notes that I was part of the team of. The first one, Central Cast in Light paper, goes back to 2000. I think I've lost track of time here, but 2019, I think that one was published. But the IMF's been very busy in this area, and I was part of the team that was leading that effort. And you see that as Pana mentioned, I'm ex-IMF now, so I'm continuing my work in sort of personal nature, and I've got my kiffmeisterblogspot.com webpage down there if you want to follow more of the work that I'm doing in this area. But I want to start with this slide here, which is kind of, I think, fundamental. I think it's the most important slide that I have here, which is to define exactly what central bank digital currency is and how it differs from other kinds of digital currency. And that's really important because I think there's a lot of misinformation out there about what central bank digital currency or CBDC is and what it is not. So first of all, a CBDC is denominated in the jurisdiction's unit of account. So if it's a Japanese CBDC, it's going to be denominated in yen, not some other currency. It's not going to be a crypto asset. It's going to also be backed by the jurisdiction's monetary authority or central bank, and it's going to be issued by a direct liability of that central bank and broadly accessible to the public for general purpose retail usage. And this is my focus is on what we call retail CBDC as opposed to wholesale, which is that second column there, which basically is a version of CBDC that only trades amongst banks and other members of the payment system. You can see off to the far left, you have crypto assets, which are things like Bitcoin and so on. They're not at all denominated. They're not denominated in the jurisdiction's unit of account. They're not issued by the central bank, but they do share some characteristics with other types of, with CBDC. So they may be broadly accessible to the public. They may be available 24/7. And then in the middle, you've got all these other sort of shades of gray, including asset-backed stablecoins. Some of you heard of Tether and so on, which are crypto assets that are anchored to units of account, like Tether's anchored to US dollars, for example. And then you have synthetic CBDC, which is kind of like Tether, but instead of being backed by, say, bank deposits and so on, it's backed by by reserves at the central bank. As far as I know, there's no really truly any synthetic CBDC outstanding out there right now, but as we'll come to a slide later that shows you that we've certainly got at least one real live CBDC trading out there. I'm going to run through this pretty quickly, but you know what? Sometimes people say, "Well, what about this? What about that?" One of the common ones is the Marshall Islands has proposed to issue something called the SOV, which will be basically issued by. They don't have a central bank, for example, but they've passed an act in Parliament that would make this crypto asset that they plan to issue a legal tender in the Marshall Islands. And the question comes up, I'm always pestered with this one, what about Marshall Islands? Is that a CBDC? And you know, I go back to that table and say, okay, first of all, is it denominated in the RMIs, that's the Marshall Islands unit of account? Well, no, because the unit of account actually happens to be the US dollar. There's in the Marshall Islands, they use the US dollars, their unit of account and legal tender. Also, it turns out that the Marshall Islands does not even have a central bank. So how can it be a central bank digital currency? It's issued by the Ministry of Finance. And in fact, that kind of brings up an interesting point. I like the title of this session, Govcoins, because this, I guess, that's what the Marshall Islands SOV is. It's not a central bank digital currency. It's really more of a Govcoin. So putting that aside, I maintain on my webpage this real-time tabulation of all the countries in the world that are playing around or exploring central bank digital currency. And you can see that the top panel there, that the Bahamas is the only country that's actually fully launched a CBDC. They call it the sand dollar, but there's at least 4 others that are piloting very actively CBDC. Those of you who read about these things will know that China has a very active pilot underway and in different parts of the country and different sectors of the economy. The Eastern Caribbean Central Bank recently launched a pilot. Jamaica's Jamaica launched one in May, and Uruguay actually has completed the pilot. But then as you go down this table, you can see that plenty of other countries, and I've highlighted the ones that I think are kind of interesting to this region here. There's lots of other countries that are very actively exploring CBDC. In fact, I'd say that the count here would be 57 countries, and I should put a disclaimer on this in that these are only the ones that I know about publicly. And in fact, there's some that I know about unpublicly, because from my ex-IMF days, I happen to know several countries that are investigating CBDC in a kind of a stealthy way. They're not publishing anything on that. But this is something that I keep posted on my webpage and update it quite frequently. In terms of motivations for issuing CBDC, and this comes from years and years of talking to central banks and reading their press releases and speeches and so on. And I think you can divide the world into two areas. One would be the emerging market and developing economies and the advanced economies. So for the EMDE economies, they tend to focus on financial digitalization and inclusion needs, and also reducing the physical cash costs and risks. An example would be the Eastern Caribbean Central Bank, where the cost of cash management is extraordinarily high, and the risks are very, very high too, because they like to, it's almost a joke, but in fact, they have to transport physical cash from island to island, and one of their big risks is literally the pirates of the Caribbean, and plus there's huge fixed costs in producing physical cash, so that's a big deal for them. And plus, some of these countries they feel that the digitalization of their economy needs a bit of a kickstart. Perhaps the commercial banks and so on in those countries are not really pushing the frontiers of digitalization. So central banks want to step in and push that along. Another is what we call reducing currency substitution. So that's essentially, or another way of saying is retaining monetary sovereignty. Some of them are under a threat from either dollarization, euroization, or even many fear the onslaught of stable coins like the DM, or what used to be called Libra stable coin that Facebook is planning to offer. So they're hoping to push back with that. Advanced economies see things a little bit differently. They're often looking at things like enhancing payment system competition. Say China, where you've got WeChat Pay and Alipay dominating the payment payment system. One of the rationales for the PBOC to offer up a CBDC is to push back on that potential monopoly. Another one that comes up mainly in advanced economies is distributing government payments. That came up in the US, where there was some challenges in distributing COVID-related stimulus payments to people, and there's quite a number of unbanked people in the US, so that came up as a rationale there. Another one too is improving payment system efficiency, particularly cross-border. Many are looking to CBDC, particularly interoperable CBDC, as a way of reducing the cost of cross-border transactions, i.e. remittances and so on. That's a big factor. And also many are looking at CBDC as a way of improving monetary policy effectiveness, doing targeted policy. And that usually is associated with the idea of having an interest rate on the CBDC. So it becomes kind of like another tool on top of the other monetary policy implementation tools to play around with that interest rate. Also, some are looking at the option or the opportunity to access more granular real-time payment states to improve the monetary policy modeling and so on. For countries that are sitting at the lower zero bound on policy rates or in the negative territory, they're looking to remunerate for interest-bearing CBDC as a way of possibly breaking through that lower bound. The catch being that in order to do that, you also have to make holding cash expensive or even reduce or eliminate the use of cash. And so far, nobody that's been doing any kind of pilots or anything have contemplated that of either making cash costly to hold or actually eliminating cash. In fact, most countries that talk about CBDC make a big point of saying, don't worry, we're not taking your cash away, which is important to some sectors in the economy. And then all of these pilots and so on are cognizant of the financial stability and monetary policy risks of issuing CBDC. And the big one is the potential for bank disintermediation and runs if the CBDC is made too competitive with bank deposits. And the way most central banks are pushing back on that is using holding and transaction size limits to limit the degree to which people can transfer funds from commercial banks into CBDC, variable interest rates and fees, i.e. having rates that are lower than the rates that are being offered by the commercial banks, and varying that to the degree necessary to contain any of this disintermediation risk. And there's other tools that are being looked at in that regard. Another potential risk is monetary policy transmission. As it turns out, though, when people look at that more closely, it seems that it's actually not a risk. It's kind of a positive risk in that the introduction of CBDC has to bring more people through the financial inclusion channel into the financial community and makes more their activities more tied into the variable interest rates that you could put on these CBDC. But as I said before, nobody has actually implemented enumerated CBDC, but it's something that I think most CBDC have built into them as a potential they can do, even though they're not doing it currently. The other risk, and this is more of a risk that the advanced economies may place on the less advanced economies, that if they offer a CBDC that is cross-border enabled, it could actually increase the risk of euroization and dollarization. So that's something that the international community led by the Financial Stability Board is very much on top of. In terms of design devices, there's two. There's one where the central bank and the users have direct relationships with each other. Nobody's doing that. I mean, that is like kind of the textbook version of a CBDC. Most are looking at something that's along the lines of the second one, which actually has the central bank issuing the CBDC, but distributing it through private sector payment service providers. And so it's kind of a private-public partnership aspect to it. And it makes sense because, I mean, central banks are not generally well-placed to offer up the user-facing activities, building wallets and running point of sales and so on. That's just not their thing. So that's all are basically opting for the multi-tier operating model. And for overarching design considerations, nobody so far, as I said before, is looking at interest bearing. And then some are looking at different variations of offline capabilities. And that's kind of a sore, not sore point, but a kind of a very, very debatable point about whether offline capability should be offered. And that's tied in with the idea that we need to also control for financial integrity risk, that is anti-money laundering risk and so on. So there's a lot of debate around the offline capacity, but the PBOC, the Chinese pilot has been experimenting with offline access. Also, if you're familiar with the crypto asset world, there's the potential for making the CBDC programmable using smart contracts. And then again, PBOC is leading the way in that regard because their pilot has implemented some programmable features in their pilots. And in terms of the platform type, some are looking at the distributed ledger technology that underlies Bitcoin. Others are looking at the centralized ledger. And one of the kind of like things we used to pound home at the IMF is that CBDC does not necessarily have to be distributed ledger based. It can be based on conventional, traditional centralized ledger. And so that you see that in the experiments. And I think we don't know a lot about the PBOC pilot, but it looks to me like they're using a centralized ledger. And then this is just a slide that talks about how the different pilots are designed around the AML requirements. And generally speaking, what they do have two different tiers of CBDC. One is designed with a very low know your customer requirements, but also has very, very low limits in terms of holdings and transaction sizes. But if you want to put up more of your information, for instance, government issued photo ID, and also link it to a bank account, you get the opportunity to increase the holdings and the transaction limits. That's very consistent pattern out there. And that's my quick overview of what's happening out there in the wonderful world of central bank digital currency.
Thank you, John. Very concise, very detailed. I think you open up more question than answer. So we will have an opportunity. If I can ask the audience that you have direct question only for this session only on CBDC, you could use the Q&A mark on top of the Zoom. And if you want us to ask the question at the end of this session, please put the question in the chat room, please. Thank you. May I come now to Nelson Chow from the Hong Kong Monetary Authority as one of the location that is doing the pilot on the CBDC. Please, Nelson, please go ahead.
Sure. Thank you. And actually, thanks, John, for the quick, concise summary. I have a team who does this monitoring of the global CBDC development, and I realize that you have already done it. So probably I just follow your website and do not need to reinvent the wheel. And thanks, John, for that. And when I first received this invitation, it actually didn't take me long to say yes, because first, because of Andrew. Andrew is a legend in Hong Kong financial regulation space. Everyone knows him. Second is actually the topic itself. It sounds, the name sounds quite cool to me, and it reminded me of the rise of Skywalker. So I knew it is Pindar's work. So you must be a fan of Star Wars or something like that. So, but timing is important. If just imagine if this webinar was held 2 years ago, I think not many people will sign up or have interest to look at it, because the topic of coins is so unexciting, right? I have a Hong Kong dollar, $10 coin here. Actually, it's a stable coin. Its value didn't change much since it's minted. Coins have been around for how many years? No one really knows, but at least thousands of years. Although no one is sure when and where exactly the first coin was minted, but some people suggested China was already using copper coins as a medium of exchange in like 1100 years BC, while some would argue that first coin was found somewhere in Europe, 5-6 centuries BC. But I think no one will disagree that the most widespread use of coins, Govcoins, in a cross-jurisdictional setting was probably found during the Roman Empire. I think some of you might have heard of the biblical story in which Jesus said, "Render therefore unto Caesar the things which are Caesar's." So the coins has been around European region and also Middle East, and the Roman Empire coins have been pretty much widespread at that time. So that was at least 2,000 years ago. So why we are discussing Govcoin today, if coins are not something new? Well, I think John has set out a very good summary. The reason is because more central banks have started researching CBDCs, both the wholesale and the retail level. And if you look at some of the sharings from John, you see more central banks are actually looking into the retail level than wholesale level. So if you some of you are regulators and central bankers, it doesn't need me to explain what is CBDC. Is basically just central bank's liability and in digital form. If you look at the wholesale CBDC space, it actually already exists in our RTGS system, right? But general purpose CBDC, commonly referred to as retail CBDC, is something new. At the HKMA, we started our work on exploring CBDC in the wholesale level back in 2017, 4 years ago, roughly, when we started the project Lion Rock to study the benefits of CBDC at the wholesale level, but in a domestic setting. In case you were wondering, Lion Rock is actually the name of Hong Kong's most iconic mountain. It stands for the can-do attitude of Hong Kong people. After the study, we actually concluded that at the wholesale level, CBDC have great potential to make cross-border payment more efficient, less costly, and more transparent. So that's why we work on cross-border CBDC with the Bank of Thailand in 2019. We started the project called Project Inthenon 9 Rock. Yeah, again, yes, Inthenon is another iconic mountain in Thailand. And we published a report earlier last year, and it's downloadable on our website from both of the central bank's website. Together, at that time, we proposed a blockchain-based Thai baht Hong Kong dollar corridor network. Put it simply, the corridor network enables banks in Hong Kong and Thailand to directly conduct fund transfer and FX transactions between the two jurisdictions with reduced intermediaries. So that means less corresponding banking requirements. Through the project, we wanted to find out to what extent can the corridor network overcome decade-old challenges of cross-border payment. To name a few, these challenges include time zone differences. So some of this fund transfer cannot be done if there is a time zone difference. It may, take several days, especially if some of these transfer have to go through multiple jurisdictions. We also want to remove the challenge of correspondent banking and the differences in rules and regulations between different jurisdictions. So these are the challenges that we want to tackle at the time. Numerous central banks and institutions are conducting similar studies. And so what makes our project different? I would say our project emphasizes on practicality. Like others, we studied the technology, the formulas, the back end blockchain technology, which one is better for in our sort of environment, and also the algorithms behind. Some will prefer a smart contract, some will prefer something simpler, but we also want to go one step further. We strive to go beyond experimentation and develop something more real with practical tools to address the pain points of cross-border payments. Let me give you two examples. First, we want to address the problems of captive FX conversions. As you know, if you remit money across border, you want to, from Hong Kong to Thailand, you need to FX conversion between Hong Kong dollar and Thai baht. In simplest term, means in the current model, we need to pre-fund the transfer. I mean, the correspondent banks and the commercial banks need to pre-fund that particular transfer before the actual transfer can take place. In our proposed model, banks can conduct this cross-border transfer at a much lower cost because the corridor network, the participants will offer more competitive FX pricing. So that reduced the need for pre-funding, for example, Thai baht or Hong Kong dollar in the setting I just mentioned. Second, if you look around the world, there are jurisdictions which still have some form of FX or capital control. So compliance is another area we look into in 2019. So our proposed model enables central banks and authorities to monitor this cross-border transfers and FX transactions in real time. As a result, banks can meet the reporting and compliance requirements more efficiently in some jurisdictions, in turn reducing the time required for making those transfers. This model would be particularly useful to jurisdictions with some form of, as I mentioned, FX or capital control. Hong Kong, of course, we do not have that. So, but for this model for this corridor to work, we have to build in such functions in the corridor network. So we finished the study in 2019, and we issued a report in early 2020, concluded that the blockchain-based corridor network has greater potential to solve many of the pain points we mentioned. At the same time, we agree that well, only Hong Kong, Thailand may not be enough. We want to have more central banks who can join and experiment and achieve, the perceived benefits. With this in mind, we continued phase 2 of the project. again, it's phase 2 of project Internet 9 Rock. We have finished that, and we will publish a report soon. This time, we aim to support at least at the current prototype, we support at least 4 CBDC in the corridor network, effectively making it a multi-currency CBDC platform for cross-border payment. In February this year, with much excitement, we have more jurisdictions joining. They are the Central Bank of United Arab Emirates and the Digital Currency Institute of the People Banks of China. We are also privileged to have received strong support from the BIS Innovation Hub. Because the project now supports more currencies in the region, it has been renamed to Multiple CBDC Bridge, so more commonly known as MCBDC Bridge. As the 4 central banks join hands to drive the project forward, all of us will make sure that we'll accommodate the needs of each other as different banks, different central banks may be at different stage of development of wholesale CBDC. So as mentioned just now, we want to maximize the perceived benefits of the corridor network. That's why the bridge has a more flexible design. It means the conventional large value payment systems like RTGS system, faster payment system, or CBDC systems can plug in easily. So if we touch upon a little bit more on the technical design of the bridge is based on blockchain, so it's decentralized in nature, and participating central banks will be on equal footing with each other when it comes to hosting and participation. So some sensitive questions such as who owns and operates the system and where should the system be located can be avoided, because everyone owns a nodes within the corridor network, and they validate their own currency and the currency paired with each other. So as I have just said, when conducting research studies, we emphasize practicality. We want to make sure our study produce practical outcomes. So that's why soon we will explore real business use cases like cross-border trade settlements and capital market transactions. We have already brought in many banks, at least 30 of them, large corporates, and 2 stock exchanges to test the bridge using actual transactions. I hope to share some good news with you all soon. The HKM may believe that CBDC offers very good prospects in solving some decade-old problems in cross-border payments. We'll continue to develop and enhance our model, and we welcome partnership with our fellow central bankers. Of course, we are aware that there aren't any one-size-fits-all solutions. So we stand ready to join force with you around and central bankers around the world, bilaterally or multilaterally. We are prepared to jointly study the potentials of new technologies in enhancing financial infrastructure. On retail CBDC, we have also announced recently that we're working with the BIS Innovation Hub Hong Kong Center on a project called Project Aurum. Aurum is the Latin of gold, which will focus on the technical aspects of issuing LCBDCs and the possible architectural designs. And John mentioned some of the models, and we actually will work on at least 2 models at the same time. Similar to majority of central banks, we see that a lot of issues, much more issues than wholesale CBDCs, need to be thought through before issuing them. For instance, how should we strike the right balance between privacy and traceability? So John mentioned about some design about when wallet size is smaller, maybe it's anonymous. When this wallet size can transact a higher amount, they need to be a registered account. So those are all need to be take care before we consider to issuing CBDC out at the retail level. So also cyber security risk is so different from the wholesale level. Wholesale level normally it's a private network between multiple central banks and the corporates and the commercial banks. But if you are talking about retail CBDC, private individuals will have a wallet. So the attack surface is much bigger. So we need to see how we can mitigate cybersecurity risks. How will RCBDC affect the effectiveness of monetary transmission? There are important questions that need to be answered before reaching any conclusion. Against this backdrop, we have begun a comprehensive study, not just the Project Aurum, but further on EHKD. We announced on the 8th of June that we'll also study the practicality and the legal issues of issuing e-Hong Kong dollar. We want to understand the use cases, the benefits, and the related risks. So this is to increase our technical readiness so that we are prepared for all kinds of circumstances in the future, including the potential for Hong Kong to issue our own RCBDC. So we have already established an internal cross-departmental working group within the HKMA to study the relevant technical, policy, legal issues. We hope to offer our initial thoughts on this complex matter around the middle of next year. I better stop here. I know that there are, Andrew is the next speaker. Over to you, Pana.
Thank you. Sorry, very innovative story coming out of Hong Kong. Very, very exciting. May I next go to Andrew Cheng in Penang, please? I think you have an overview of this, the perspective, all these innovation and development. Please, Andrew. Please unmute, please. Andrew, you need to unmute. Andrew, you need, yeah. And Andrew, please, yeah. Yeah,
Sorry,
okay, you're on.
Yeah. My technology has not been as good. I really thank Kun Pana, the Asian Usenet, Star, and the Investor for organizing this wonderful webinar. I think it's extremely timely. And I think John Keefe has given a superb overview of the technical aspects down to a lot of detail. Nelson Chow of HKMA, as you know, I used to work in HKMA, has given us a very good perspective, very up-to-date, comprehensive approach, extremely practical on how to advance the CBDC agenda. What I would like to do is to answer the key question which Kun Pana has given me, is whither monetary policy, and basically it's an overview, okay, which is absolutely, and maybe because I'm kind of not in the front line, I can say certain things that are maybe not so politically correct, but needs to be said. So the first question is, where is monetary policy going in the age of e-money? The answer is the objectives of monetary policy has not changed. Okay, that part is very clear. Monetary policy is to help control inflation, promote the environment for stable finance, and growth in the economy, including provision of jobs. That has not changed. Unfortunately, the context has changed. The whole real economy has changed. The politics has changed. And I think, so therefore, the attention of central banks into CBDC is a response to the contextual change. And what is that contextual change? Well, let me put it in two ways. Number one, in the old days, monetary policy can be easily conducted because the banking system was the primary channel of money and the relations in the economy. So in less advanced financial markets, the banking system is 80% to 90% of the economy. Today, worldwide, non-bank financial intermediaries account for more financial assets than the banking system. This is the Financial Stability Board's latest data published in 2019. And then in last year, because of the pandemic, the non-bank financial intermediary lending was higher than bank lending to the private sector. So suddenly, the central banks are in charge of banking systems, but the money's role in this is not as important because most of it is in the non-bank financial intermediary, which has become bigger in the capital markets, in the derivative markets, etc. So this is the a very fundamental, a big contextual change. But exactly,
Stephane audience đã đừngขึ้นมาหน่อย
exactly what Nelson has said very accurately. 2 years ago, we couldn't have this conversation. And that's because the technology of blockchain, artificial intelligence, and big data has advanced to the stage in which it's no longer about banks versus fintech, it's about banks versus big tech. And big tech is coming into the markets in a very big way. And they're not even non-bank financial intermediaries, but the technology that they have, the spread that they have would change the game. And if in the old days, banking transactions were secure, today with blockchain, a big tech can provide as much. And increasingly, they are entering into the field of payments, data extraction, and then provision of finance-related services. So if you're an insurance company and you have big data, you can provide medical services across your platform, and at the same time, you can provide payment services and asset management services, etc. So the situations become much more complicated. And so what John Keefe and Nelson have given you very great is to give you that the objectives of monetary policy may not have changed, but the implementation the devil is in the details. And so, we really need to understand this. Now, out of this, a big picture contextual change, including the technology, is a political one. The political one was that with blockchain, the private sector realized that if central banks can issue money, maybe we at the private sector can issue money. So let me give you a very interesting fact. This year, the value of cyber currencies, e-currencies, which are not issued by the central banks, right, has a market value of roughly $1.2 trillion. This is half the value of the official reserves of gold. And now, as we know, gold is one of the oldest currencies available. So digital currencies, in a matter of less than 10 years ago, before Satoshi Nakamura, whether he exists or not, has created this new currency, cyber currency, and suddenly it has a market value of 1.2 trillion. But of course, recently the volatility is huge. But investments in cyber currency was the highest yielding asset. Whether you believe it, you actually gain it, and that's another matter. Last year, compared to gold and stock markets, etc., etc. So how do you interpret this? There are two political implications on this. The first is that the private sector, and there are a lot of people out there who believe that they want to create a currency completely outside the purview of the official sector. And the more you regulate the banking system with AML, regulation, capital requirements, the more the business shifts to the non-bank financial intermediaries. And the more you regulate the non-bank financial intermediaries, it moves into the dark area of where nobody understands what's going on, which is where a lot of these private cyber currencies is. And the big lesson of COVID is that private cyber currencies will be with us whether we like it or not. That means you cannot completely eradicate it, but you have to live with it. So then we come back to the issue of how does monetary policy work in this context? And the answer, of course, it is extremely complicated. And that's why the central banks have now driven into CBDC to make sure that their core values, their core business of money is protected. Okay? And what the HKMA, the Bank of Thailand, and the BIS is doing is superb. And I would very encourage you to follow what is happening in this area. So but the monetary policy issue, again, I want to repeat what Nelson said. Well, what are the channels of monetary policy? And the answer is the channels of monetary policy is no longer just through traditional fiat money. It will be through e-money channels, right? And that's why the real answer is what is going to happen, nobody knows. This is not theory. This is all about practice. And you literally have to slowly get deeply involved. And then you cannot do this alone. This money is not something that one central bank can control in today's age of free flow capital. You have to work with different central banks, and you have to work with stock exchanges, because stock exchanges where they are turning over transactions tremendously. And maybe you have to work with Walmart, particularly if Walmart says, I accept, Bitcoin, suddenly, Bitcoin has a value, right? And so to a large extent, central bankers are finding the management of monetary policy much more nuanced, much more complicated than before. And therefore, the work that the IMF, BIS, HKMA, different central banks are doing, trying to achieve seamless payments, much better compliance with for the banking systems, better connectivity with stock exchange clearing houses and maybe FX clearing, et cetera, is absolutely the right way to go. But, we have to step back and need to understand that we are on a verge of a major political change. This is not just a technical change, a financial change, because the biggest currency that is being used today is the US dollar. And that if the Fed, who has been relatively slow compared to others in using in pushing out the CBDC, has suddenly woken up to the idea that if many more CBDC currencies appear, including, for example, something linked with, let's say, the euro, the relative position of the dollar will be hurt. And to give you an illustration of how political this is, this year, the euro transactions in SWIFT is now higher than the transactions using the dollar. And the reason is the United States have been using the dollar network to impose sanctions against certain individuals, companies who use the dollar. And therefore, there is a shift as companies, individuals, governments decide to hedge, it will play into the decoupling story. Now, how will this end? Nobody knows. I'm not going to try and predict all this, but I just want to lay the issues on the table. So I think, to summarize, monetary policy hasn't changed. Monetary policy cannot be conducted today independently by a single central bank. It is now coordinated, not just with other central banks, but with other regulatory authorities, and today also with technology. On that note, let me hand it back to questions and answers. Thank you very much indeed.
Yes, thank you, Andrew. I think we breezed nicely into the second session with all the things that you have mentioned. John, Nelson, and Andrew, please feel free to ask and talk to one another. But and we have questions, and thank you for answering the question on the Q&A. I have some quick questions. First for John. So what happened if the Fed produce CBDC and the dollar is flooded on the mobile phone, around the world? How do you foresee that?
Well, that's a huge question, isn't it? And that's why the U.S. and so many other countries are involved in these working groups and so on that are sponsored by the Financial Stability Board and the CPMI and so on. Because as I mentioned in my slides, one of the big risks there is that an interoperable cross-border enabled CBDC issued by a major currency central bank such as the Fed or the ECB, I mean that risks accelerating the dollarization or currency substitution in other countries. And so I think they're very aware of that and be very careful in how they implement the cross-border nature of a CBDC. If they just did it sort of nakedly, they just sort of, hey, we're just doing this. We're going to issue a CBDC that can be transacted the world over. I mean, I think that it could lead to an acceleration of currency substitution in many other countries that would be problematic to the implementation of monetary policy in those other countries. So I think that the key here is this coordination, which is happening at the highest levels.
Okay, thank you. Nelson, I'd like to know how the consumer in your pilot, how's the consumer reacting to the government coins and other e-wallets? How do they pick and choose?
If you look at the wholesale level research have been more mature in our current study. So the corporates are happy to explore different options, especially if they can get advantage in terms of FX conversion. If you look at the corporates, importer, exporters, day in, day out, they have to settle a lot of trades in different currencies, especially for smaller jurisdictions. They will find it difficult to get a decent FX conversion rate because of the spread. Naturally, but between some currency pairs, maybe not very common. So I think the corporates, they're happy to get involved, and of course the exchange are happy to get involved because of the potentials of the capital market use cases. But you mentioned about consumers, and as our retail CBDC project has just started a couple months ago, we haven't engaged the retail level consumers. And honestly, even back in 2017, after we finished our first round of studies, we realized that in Hong Kong, a retail level CBDC might not have a lot of room for developments, because if you look at our current e-payment schemes, we have the traditional credit cards are widely used, and also we have at least 6 e-wallets, and they're competing with each other, providing better service to the consumers. So all these have been very attractive to consumers already. So what's the point of having another Govcoins per se? So we must have a very unique use case that we want to pursue, because we do not want to innovate for innovation's sake, right? Because other people are doing it, but we want to be equip ourselves, get our hands dirty to make sure we are technically ready, because there are so many different things that we need to consider before we can issue really a retail level token. Maybe there are things that we haven't think about, but the private sector can innovate using a retail-based CBDC. Some people have suggested micropayment. Maybe that is a a niche area that Govcoins can play a role, financial inclusion, all that. So basically, hope I have answered your question, Pana.
Yes, thank you. Andrew, you mentioned that.
Can I just jump?
Yeah, sure.
Can I jump in here? I just want to mention, I think I didn't mention it in my tabulation of risks, but I think one of the risks of offering up a retail CBDC, as Nelson kind of alludes to, is a failure, that it doesn't really attract much interest, and there are reputational risks to the central bank in offering a CBDC that turns out to be a massive flop. And I for instance, I focus on the US, where that's where I live, and I've got plenty of digital options. I think there might be some niche cases for CBDC, but there's actually other ways of dealing with those niche cases. For instance, regulation could be an answer to solving some of these niche problems, like the unbanked in America. There's about 2 million people or so that are unbanked in the US, and maybe there's a regulatory response to that rather than offering the CBDC. For instance, if a person that's unbanked is unbanked because they don't trust banks and so on, are they any more likely to trust the Fed and run and be embraced by a Fed issued CBDC? I'm kind of doubtful about that.
Yes, thank you, Andrew. You said we have to live with the competing currency, the crypto and so on, forever. But would they be an analogy to gold? Gold is a speculative, but it's not movable, that easily movable. Would that, how do we perceive? Would that be the perception, the right perception?
Well, today, if you were a refugee, would you carry currency cash, gold, or cyber currency? And the answer is that they will probably carry a cyber currency, right? So to a large extent, cyber currency won't go away, because the mobile phone is today, your most important tool. And even if you're a refugee running away from, civil problems, you will probably carry, a mobile phone and maybe or at least remember the passwords for your cyber currency, so that when you get to another place, you can get money, right? I mean, so to a large extent, don't expect cyber currencies to go away. This is a fundamental point. Okay.
That's a question.
Yeah. The other point that I really want to add just now is that if you were Walmart or Amazon, and you are now selling, not just to the US customers, but worldwide, and you are able to issue a token that you can buy with US dollars, right? And literally, buy this token, and then you can then buy any Amazon product that you need, including, issue a credit card using that token. Is that currency? That is more or less currency, but it's internalized within the Amazon or Walmart network. And that has always been the fundamental difficulties of, trying to enforce just pure usage fiat currencies, because, the transactions cost across border particularly is up to 7% of the transaction value. And today's even, banking has not solved this fundamental problem. And therefore the very large digital networks, like Amazon, like, Walmart, when they get into it, Facebook, etc. If they are able to issue Libra, they can capitalize on that transaction value and obtain, a lot of value from this, monetary creation by themselves.
Yes, we have time just for two quick questions. One is from Anthony Lim to Andrew. Given your statement, and I do agree that it is not optimal for any one central bank jurisdiction to work alone in rolling out CBDC. Will it be more efficient to organize CBDC at regional level, like having an ASEAN coin?
Well, in my view, to try and issue an ASEAN coin may or may not make sense. Because what will happen is that they don't want any new regional currencies against each other, but they don't mind a pool of ASEAN currencies that are probably CBDCs, right, that can be used for settlement. So since that intra-ASEAN or intra, FTT or TPP plus or intra RCEP, if you are able to introduce a netting and clearing network to facilitate trade payments, this may be a great advantage. So for ASEAN or ASEAN +3 to do this, this may be something that the ASEAN +3 central banks may find it useful. But the fact that BIS is also involved in this and IMF has an interest, it will help a lot.
Okay, thank you. And final question from somebody anonymous asking, will CBDC make cryptocurrency obsolete? And how do they coexist? John, please.
Oh, I'll take a shot at that one. I mean, my sense is that there's kind of two answers. One, in the existing environment, I don't think CBDC would make crypto assets obsolete, because I think CBDC are going to have to operate within the confines of the Financial Action Task Force, AML, CFT regulations, KYC, and the whole 9 yards, whereas cryptocurrencies in many cases now don't operate in that environment. But on the second part of the question is that I think we're all seeing this now, that the regulatory and legislative walls are closing in on crypto assets, and they're coming under the same rules that other types of conventional currencies operate under. In that case, it kind of levels the playing field, and perhaps in that new world, CBDC and cryptocurrencies coexist, or maybe crypto assets become redundant at least as a payment medium in the future. That's a possibility, but it's kind of all very speculative at this point.
Thank you. Any remarks, Nelson, on that?
I think they are two different animals, and if you look at the crypto world, how many of them are looking at really solving payment problems? If you look really at it, a lot of them are a lot of the one who get into it, it's speculating and treating it as a store of value. So when you're talking two different animals, they probably will coexist. But of course, it really depends on whether the second animal will get into too much illicit activities. Because if so, I think global central banks or regulators will change their stance very quickly.
Thank you.
I think stable coins are kind of the battleground that we're seeing that played out on right now. And for instance, in the US, there's proposed legislation called the Stable Act that is going to try to bring US dollar stable coins under the same sort of inside the same regulatory perimeter as other kinds of payment media. So yeah, I think it's kind of an open question right now as to where all this legislation and regulation goes.
Thank you. I'm sorry we ran out of time. I think we can keep on talking all day. I hope we have an opportunity for another session sometime in the future. And I'd like to thank John, Nelson, Andrew for being us today. And I think we learned a lot. The audience number now is 243. So very, very inclusive, active audience. May I end this session and go to the next session, please? And
thank you.
And yes, thank you very much. I think
Thanks,
with that
Pana.
content, thank you. With all that content in the first session, I think we breeze easily into the second. I think everybody opened a can of worm for Professor Kevin Werbach to make his remark on the centralization of finance. I think it's a hot topic also at the moment. Please, Professor, speaking from Philadelphia.
Great. So thank you very much for the opportunity. A pleasure to virtually be here. As you heard, I'm a professor at the Wharton School at Penn. I've been researching blockchain for a number of years, since 2017 or so. I've been working with regulators and policymakers around the world to work through some of the challenging issues that are posed by these new assets and new applications. I now direct something called the Wharton Blockchain and Digital Asset Project. And the title for this second part of the session is what's next for crypto? And so if that's the question, the answer is DeFi, decentralized finance. And there is a connection to the CBDC discussion you just heard. CBDCs will be one of the, and potentially the predominant asset underlying DeFi activity as they get developed and launched into the world. But also, if we really want to imagine CBDCs being transformative, not just an incremental advance on the kinds of money and digital money that we have now, the real exciting potential of CBDCs is programmability, is the opportunity to add constraints and attributes to money. It can only be spent in certain ways. It can only be used in certain places. It has certain time limits and other features to it, making money into a flexible asset like other kinds of data that's transacted on the network. And that kind of functionality is the sort of thing that DeFi can provide. And so we'll see, I think, a convergence of these two worlds going forward. But let me just step back a little bit and talk about why I think DeFi is so important. DeFi is the answer to another critical question, which is, what's the killer app for cryptocurrencies? Because we really haven't seen it yet. Bitcoin was launched in 2009, and the idea of Bitcoin was the killer app was payments. We would all be using cryptocurrencies to buy things in traditional retail payment applications. And that basically has not happened. There are some edge cases, there are intermediaries now where you can use Bitcoin or another cryptocurrency, and then on the back end, typically they'll immediately transact it back into fiat because it's so volatile. There are lots of reasons why, for most people, most of the world, again, there are exceptions, there's no reason why you'd want to use a cryptocurrency to buy something instead of one of the very sophisticated payment apps, Alipay, WeChat Pay, PayPal, anything like that. So that hasn't really taken off. The second big answer that came to the fore was Ethereum's answer. What's the killer app for cryptocurrencies? The idea there with Ethereum and smart contracts was cryptocurrencies power decentralized applications, that there would be this world of these network-based, decentralized programs running on blockchain networks, and cryptocurrencies are the native assets that power them. But again, even though that has led to a great deal of activity and a lot of excitement and lots of networks and lots of tokens, again, we really haven't seen transactional activity as opposed to speculative activity, people buying and selling those coins as an investment asset. There was really, until 2020, very little transactional activity. End of 2019, only one Ethereum DApp, decentralized application, over 1,000 daily active users, okay? Only one app that had 1,000 people using it every day. That's not a very big number. So then what happened in 2020? What happened in 2020 was the explosive growth of DeFi. So assets locked in DeFi smart contracts, i.e. cryptocurrency that is provided into DeFi collateral or liquidity pools, beginning of 2020, under $1 billion. End of 2020, 14 billion US dollars. May 2021, 85 billion US dollars. Now about 57 billion, even after the crypto market correction. These are starting to be really interesting numbers. 95% of all of the growth in decentralized applications in 2020 was DeFi services on Ethereum. And these are a whole range of financial services, services for trading, services for lending, services for derivatives, asset management, insurance, anything that you can think of as what we call a financial primitive, as some sort of financial services activity, can be delivered in this mode. And it gets even bigger if you loop in NFTs, non-fungible tokens, which some of the other speakers may touch on, so I won't get into it in detail. But NFTs are, again, another kind of asset class that can be transacted through these DeFi mechanisms. And that's where we've seen explosive activity, both for collectibles, but also in gaming. I would direct any of you who are trying to see something that is on the cutting edge, which is in some ways somewhat scary and uncertain of where it's going. Go look at Axie Infinity, which is a Pokemon-like game that now has hundreds of thousands of people playing it, predominantly in the Philippines. Generated $79 million of revenue of people buying these NFTs to buy these digital assets in the last 18 days. Again, a lot of uncertainty about where that might grow, but that seems to suggest that there is real activity happening. This is not just people buying and selling based on the price. This is people actually doing things with the tokens. All right, so what is DeFi? I led a project in collaboration with the World Economic Forum called the DeFi Policymaker Toolkit. You can find it on the WEF site. The URL is wef.ch/DeFi Toolkit. We identified 3 attributes of DeFi. First, that it is financial services that are trust minimized in their execution and settlement, i.e. the base layer, the underlying rails for settlement are blockchains. Public permissionless ledgers. Second, non-custodial services. Traditional financial services tend to be custodial. You give up control of your assets to the intermediary. DeFi services don't operate that way. Users control their own assets, even when the services are being provided. And third, services that are open, programmable, and composable. So this is open source software, which is programmatically accessible through interfaces as opposed to the centralized silos of traditional finance. What does that mean? Transforming all of finance into software. So this is not just fintech, i.e. reconceiving and rebuilding things like banks using internet-based software. This is getting rid of banks and saying a bank is just a set of software calls that take deposits, engage in lending, and facilitate payments. And that software now can run on decentralized, public, permissionless blockchains, open to anyone around the world, not just as an end user, but as a provider of liquidity into these pools for services. Disintermediated, services that can be delivered without traditional intermediaries, transparent. All the transactions are on a blockchain ledger. And potentially with decentralized governance, where many of these DeFi services have tokenized systems that are used to decide on important attributes like interest rates that get charged on loans. So huge amount of activity here, but a number of really critical questions. So this is very immature technology. Despite those numbers I told you, many failures, many hacks, many scams, close to 300 million US dollars lost between 2019 and beginning of 2021 in DeFi hacks and other kinds of attacks. Frenzies of speculative bubble-like activity where tokens are being used to pump up some of these returns in unsustainable ways, hidden centralization, and a whole series of really serious regulatory concerns. How do you do anti-money laundering compliance when the application is just software, when there's no identifiable service provider? How do you protect investors when everything is software-based? And how do we ensure financial stability? We've seen already with the way software drives so much of traditional finance, how that contributed to the global financial crisis and other crises. This potentially magnifies that risk in all kinds of unpredictable ways. So regulators now are looking at this question. What do you regulate? If there is not a company, if there's not an entity, if there's not an intermediary that is the hook for these rules to apply. And there are mechanisms to do this. Some of them involve ring fencing in terms of limitations on how traditional regulated financial service providers can interact with these DeFi services. Some of them involve defining certain functionality and requirements on people who are involved in the provision and facilitation of it. And some of it involves regulation of some of the pieces that are easier to see, like stable coins. And as was mentioned before, this is really where a lot of the regulatory debates, at least in the US now, are starting to come to a head, figuring out what the regulatory regimes are going to be like for privately issued stable coins, as well as the government issued CBDCs. So all of this right now is under debate. It is something of a fork in the road. But what I would say is the crypto community often tends to have this notion, and you know, it's not just crypto. I've seen this for the past 20 plus years in emerging technology markets. There's always this notion that we have to choose either regulation or innovation. And I think that's a false dichotomy. There can certainly be bad regulation, but actually for new technological markets to mature and develop, they need to be trusted. They need to get to the point where ordinary people around the world are willing to participate in these activities at scale. And regulation is an important part of that. And so really the question is whether DeFi goes down the path of just being a frenzied, unregulated casino, which ultimately is going to crash and crash again and take users' money, or whether it does what it has the potential to do, which is really grow into the future of finance. And so I'm betting on the last one, but we have a lot of work to do, both in the technology and entrepreneurial community and in the public policy and governmental community to get to that point. Thanks very much.
Thank you, Professor. Very comprehensive outline, a lot of challenges. May I next come, the next two speakers are from the private sector. I think we'll be interested how they see how the world finance is moving. Revolution or evolution? Stephane in Colorado, please go ahead, Stephane.
Yeah, thank you, Pana, and amazing, Kevin. I think we share a lot of the views on what is the ecosystem and where it's going. Quickly, I'm Stephane De Baets. I'm president of Elevated Return. We did one of the world's first tokenization of trophy asset in 2018. We put the Synergis Aspen on a digital currency. It's currently listed on T0. We also added perks to the digital security to make it more consumer friendly. And at the same time, I'm working in Thailand. I'm the major shareholder of Xspring Capital, which is a financial service company that really assembled the old world together with the new world. Because I do not believe that you need to take the world of finance, move it upside down and say, we're gonna reinvent everything and throw everybody else by the window. I think that what we do here is very similar to what email has done to communication. We used to use fax to communicate to each other, and suddenly came email. And the first thing we did the same thing that what we were doing by fax, by email. But then we realized that because it was so quick, so efficient, you could actually communicate other things on email that you would never do when you were communicated by fax. Like I could invite you, Pana, for a drink tonight if we were in the same country by sending you an email. I would never do that by fax. So I think that what we're going to see with the blockchain technology, we're going to see an evolution of existing product into a digitization of those products. But then very smart people in innovator will say, now that that exists, what else can I do with it? So I'm going to talk a little bit about what is the framework of crypto today. You have really 4 different asset classes. The first one is you have store of value, which are Bitcoin or potentially stable coin. The second class is what I call the smart contract platform. Effectively, these are infrastructure play. These are the Cardanos of the world, the Ethereum of the world, the Polkadot, the Tezos. Then what you have utility, which are basically a way of funding a project that's going to provide a service or a good in the future. And lastly, you have something that everyone has been talking about for a couple of years, which is security token. Why don't we move the whole custody, trading, clearing of securities onto the blockchain? Because it could be immediate, cheaper, faster, and global. That's where we are today. What do we see as potential trend using the technology? You could create what I call enhanced securities. We were talking about Walmart creating a form of payment, but why don't you add a loyalty program to shareholding ownership, for instance? Why is it that I can be a stakeholder in Apple, but I cannot use my Apple shares to buy an Apple product? Because if I'm a consumer, I'm a stakeholder into the Apple ecosystem. If I'm a shareholder, I'm a stakeholder as well. So I think that people will start combining different programs into a smart contract. We call them enhanced securities. And we've already talked in the first session that was completely amazing, especially I'm operating in Thailand. And I know what the BOT, the Central Bank of Thailand, is doing with the HKMA, the Monetary Authority of Singapore. They try to figure out and say, how do I use that programmable money to do a better service? And think about what it could have done in the pandemic. When the US government wanted to go and support businesses, they had to issue a PPP program, have intermediaries looking whether or not people were qualifying for the stimulus or for the support, and then the money was channeled through the banking, eventually, maybe or maybe not to the right pocket. What if there were wallet specific to certain industry, and you could actually plug in support stimulus straight into the end user? I think that government's going to figure that one out as well. I personally believe that, and we're going to go to the fourth slide of the presentation that I put together, because that's going to help a lot of people. I believe that something's going to happen here. Is people's going to realize that you can use blockchain technology and smart contract to create what we call utilitarian money. And let me explain a little bit what's the thought process here. People know that eventually, is the next slide, please. People know that eventually you work in order to create an income. With your income, you're going to spend it on food, lodging, education, healthcare. And truly, money is only a form of transition between the income generation and the spending. What if you could actually hedge your future need by buying utility coins that give you access to what you want in the future? For instance, why don't you have prepaid hotel room? Why don't hospitality sector, and I'm in the hospitality sector, hook up together and say, I'm going to basically sell at a fixed conversion rate a room that will never expire, that will be tradable on an exchange portal. The future traveler is going to say, this is great. I can lock my price right now for consumption in the future. And you could do that for food, education, lodging, healthcare. And I think that once you do have those form of token, and by the way, right now everybody try to decide this is a security, this is not a security, it's irrelevant. We need a new regulation that deal with the asset class, because you could issue something that is not a security today and become a security tomorrow, or vice versa. And I think regulators are going to figure that one out as well. But once you have those tokens, and I call them no loss token, and the reason is you can always utilize or spend your way out of your investment because there is an economic use for the instrument. Once you have those tokens available, then I'll go back to Kevin and say, you are so right, DeFi 2.0 is going to change the world. Why? Because you have the basis to do this disintermediation based on the economic valuable instrument. The problem that I have today is that whether or not Bitcoin is relevant, it is obviously because of the size of the market cap, but it is still the same principle as a fiat currency. It's based on trust. Ethereum and the whole DeFi is basically Ethereum square. I'm going to give you Ethereum so that there's going to be somebody that's going to create an algorithm to do an arbitrage on Ethereum. Is going to give me a new coin, which is based out of that ecosystem. And the more people use it, the more it goes up. But we also know that on the other hand, if it goes down, the whole thing crumbles. So I believe that what's going to happen, and with proactive regulators, such as the one you can see in Asia, that clearly give a regulatory framework for people to innovate and issue currencies, we're going to have new form of token that we don't really talk about today. So we as a private sector company, that's what we do. I like to go, whether I sell a debenture, I want to tell my people, if it's not liquid, or if the company has a problem, there is another function you can do with your instrument. And effectively, what we're going to do, we're going to disintermediate the finance sector by connecting the consumer and the company in a straight line. So I would say today, before we talk about revolution, we need to contemplate evolution. The first step will be, let's digitize what's existing today. Why is it today that if I want to move my securities that I have at Merrill Lynch in the US to my stockbroker in Thailand, I need to spend 2 weeks, fill up 15 forms, and I cannot clear it right away. There's something wrong. We were doing the same in 1933 when the Securities Exchange Act was. I think that we're going to see an evolution. The potential of blockchain is going to lead to more and more economic viability attached to the coins. And I think this is when you're going to see really, truly mass adoption, and then room for DeFi 2.0 and other innovation. That's our view.
Thank you, Stephane. We move nicely into the issue of trust and whether the money can move quickly through the platform. May I go to Marcus Lim in Singapore, please? Marcus, go ahead. Let's go.
Yes, hi, everyone. Thank you for this opportunity to speak. So to introduce myself, I'm Marcus Lim. I'm the CEO and co-founder of Zipmex. I'm currently based in Singapore, serving my last day of quarantine. So very happy to get out today. So Zipmex, we started back in January 2019, and we are actually regulated in 4 jurisdictions across Asia Pacific. So Singapore is our parent company. Our parent company is in Singapore, and we're regulated by the Monetary Authority of Singapore. We're regulated and licensed by the SEC in Thailand. And then we're also regulated by the BABAPD, which is the Commodities and Futures Exchange in Indonesia, and then Austrac in Australia. So we started off as a digital asset exchange, and where we're kind of moving towards is to become a digital asset bank. So without kind of going straight into it, I guess to give you a bit more of a macro landscape of Southeast Asia, and I think, just to call out Singapore as a bit of an outlier here. I think what we've seen with Southeast Asia, especially in Indonesia and in Thailand, is that evolution that's happening, and what Stephane has also mentioned. The technology evolution and the shift in paradigm has happened really very quickly over the last 5 to 6 years. In terms of internet penetration, you've got mobile phone penetration, then you've got e-money penetration, and then you've got a whole bunch of financial services penetration that is happening on tech, right? And so what we've seen is obviously a huge move from the regulators to start regulating e-money, as been talked about, and also various parts of the financial sector, and also how commerce is being done in the respective countries as well. And what we've seen is that, if you look at investing in particular, the penetration rate for investing is extremely low in Southeast Asia. So take the US, for example, there's 55 participation rate out of the entire population of the US. And that's pretty high. Compared to Indonesia, for instance, the penetration rate is actually about 2 to 3% of a population of 270 million people. And if you look at Thailand, that number is not too far off as well, 5 to 10%, right? So you've got huge, population here, but very low kind of adoption rate historically, in terms of actually investing or participating in the financial market. And one of the major reasons for this is because of, the lack of education, primarily of the population, more specifically in, financial education, And secondly, because of lack of technology. What Stephane had mentioned about, opening up a stock brokerage account in Thailand takes 2 weeks. That shouldn't really happen. If you look in the US, you can open it in the same day. What we're trying to do is we're trying to, basically streamline that whole process of opening an account, KYCing, and being able to deposit, fiat, and then to be able to invest. For us, our role, and I guess, there are many roles that we play in this sector, but I guess for today's topic is really to be the trusted gatekeeper. And trust is extremely important in the financial services industry, as we all know. And the public relies on the regulators for this trust. And in our business, the regulators have issued us licenses. So they have kind of transferred that trust to us as a private sector to operate, to uphold the regulation and uphold the law. And what we've seen really is, there are challenges, in these two kind of parties. You've got the regulators and you've got the customers or the public. On one hand, for the regulators, the real, kind of the challenge here is, innovation is always ahead of regulation. We all know this, and it's not just in Southeast Asia, but around the world. And because the industry is moving so fast, and especially in the blockchain and crypto space, it's extremely difficult for regulators to keep up effectively. And because it's very difficult for them to keep up, it is very difficult for them to do policy making and to be able to set the right regulation for the specific sector or for the broader sector. And what we have experienced is that, because regulators are so new into this space, what they do is they retrospectively rely on traditional policymaking and regulation, what they've seen in the traditional financial market, and trying to apply this into our world, which obviously, has, there's a lot of, things that are not applicable from, the traditional kind of stockbroking world or asset management world to kind of like, the digital asset world. And, and so for each regulator that, that we deal with in the 4 countries, each regulator have a certain focus, right? In Singapore, fairly clearly because of, what had happened with 1MDB, AML, and CFTC is, CFT is a huge kind of focus for them. So KYC compliance, in Singapore, they've kind of, introduced a travel rule. So, for kind of any deposits and withdrawal of tokens, there needs to be a verifiable way of who that person is and where it's coming from. So that has been a huge focus there for Singapore. For Indonesia, it's really different. For them, it's about segregation of this, I guess, our entire role in the space as an exchange or a digital asset platform. Because typically, if you look at, our business as an exchange, call it, we are, the basically, the one that's doing the KYC, the compliance, we're the so-called the brokers with the exchange, with a custodian. And to some sense, the kind of the e-money or the e-wallet, right? So that's all kind of gelled into one. And in Indonesia, and again, kind of going back to my point before about, having, I guess the different kind of segregation of different duties, the way the Indonesian regulator looks at it is, the exchange has to be one entity, the custodian has to be another entity, and then, the settlement has to be another entity as well. So they're more primarily focused on, the segregation of duties, but also the underlying factor here is, ensuring that there's, proper coverage on AML. On Thailand, AML, of course, is the utmost important, but, they're more focused on transaction monitoring. So making sure that the trades, there's no front running, there's no spoofing, so, we are required to kind of report to the regulators on a daily basis. So they're most focused on that component of regulating this whole industry. So our challenge really is every regulator has, kind of different slants or different focus on how they want to regulate this entire space. And the benefit and also the challenge for us is how do we amalgamate what they want or what everyone wants and then be able to build a system that complies with everyone. And so that's really kind of the challenge. But the benefit here is that what we get out of it is to become super robust in the way we kind of work with the regulator. And I think that the third challenge here for the regulators is, developing a knowledge center, because with the regulators, like a private enterprise, there will always be, turnover. And so when a turnover happens, the knowledge is lost. And then new people come in, and because they don't know or enough about the blockchain and crypto space, it takes a very long time and it's very challenging as well for them to kind of skill up, and then at the same time to be able to regulate us. So really the way we see as a broad solution here is, because this industry is really new, typically with the regulator, and I kind of like to use, the game of tennis as an example. The regulator is usually the umpire and we're the tennis player. But I feel like in this paradigm, the regulator and us should be in a doubles game, right? So we should be collaborating and working together with the regulator, as opposed to, the previous relationship of an umpire and player. For the simple fact is, because this industry is so new, the regulator relies on us for the information and knowledge, right, and the developments that are happening in order for them to build in proper public policy making. And I think this is really kind of the key thing here. And so really our responsibility, right, is to maintain and uphold the regulatory requirements, to ensure compliance and risk assessment and management, and then of course to provide regular regulatory reporting. And also I think the key here as well is, as I mentioned, the education and consultation is very, very key as they kind of start to progress on. And we see this as well with all the regulators across the region, where it has been very consultative, and they take in reference points from various different players within each of the countries, and also speaking to other regulators in cross countries to understand better what is the best way kind of moving forward, because each regulator will make mistakes. And when they make their mistakes, they will be able to kind of share that knowledge amongst each other. So I think that's kind of really important. And I think that's really the solution here. And for us to be, that gatekeeper working with the regulator to move this forward. The other side of the equation is obviously the customer here. Now, when I started, giving this presentation, I set the context that, in Southeast Asia, there is really a lack of financial education amongst the entire population. One of the presenters also mentioned that, the unbanked population in the US is, 2 million people. Well, in Indonesia, it's 60% of the population. And so firstly, you have 60% of a population that has no bank accounts or very little access to banking facility. And let alone, obviously having the right financial education over here. So the real complication for customers is, having localized education in general investing and personal wealth management. So it's not even in investing in cryptocurrencies. Let's just leave that all aside. It's the education of how do I invest, how do I spend, and how do I save, right? Now, as I mentioned at the start, Singapore is a bit of an outlier because Singapore's, working language is English. And so, a lot of that information from the US or the UK can be transferred across to Singapore. And so we have a population that is a lot more educated because of that similarity in language and also the progression in society. But if you look at Thailand and Indonesia, the working languages are different. And it's only unique to those countries, unlike in South America, for instance. And so because of that lack of information and also that lack of education, people don't have do not understand the ability of how to kind of invest, spend, and save. And that's really the key thing. I mean, just going back to Keynesian economics here. And what we typically see, before the whole technology paradigm is, investing is really primarily for the top, 0.1% of the population in these countries. And hence, that's why there is this massive and a wide spectrum of income inequality in these countries as well. Now, kind of looking at, what technology has done over the last 5 years, then you've got, a whole barrage or overload of online information or misinformation. And then on top of that, you have bad actors in our ecosystem that causes a lot of confusion, fake news, and really kind of destroys the credibility of the market here. And large proportion of them, of these investors, as I mentioned, are really kind of first-time investors. They have effectively, if you look at Africa, people have kind of skipped, laptops and go straight to mobile phones. In a similar fashion in Southeast Asia and Indonesia and Thailand, people have skipped desktops, laptops, and go straight into mobile phones as well. So for a lot of them, they have also skipped investing in the stock market and go directly into digital assets, which is really interesting, but also at the same time, poses a lot of risk because they don't know how to invest. It's their first time investing, and they're investing in an asset class that's super volatile, right, compared to stocks. So the question is, what do they invest in and how do they invest in? And really the last part here is, we have, unfortunately, bad actors and perpetrators in our ecosystem that really, set us back a few steps in the way we're trying to progress as being gatekeepers for both customers and also for the regulators. And really for us, as that central point or the intermediary between the regulators and the customers, to our customers specifically, and as a regulated institution, our responsibility is really to educate customers first and foremost about how to manage their own wealth. Let's just, take cryptocurrency investing aside. How should they be managing their own wealth, right? Because that step or that huge gap in financial knowledge is completely missing. And that's really our responsibility here. And so what we're positioned to do, because we're across all these different regions, is we're able to kind of be that central point of knowledge center where customers can come to us, and to some extent also the curators of the information that we provide, because there's so much information out there on the internet, right? For customers to be able to learn, how to actually manage their money. That's the first and foremost, right? And when they learn how to manage their money, as part of, managing their money is investing. And what should they be investing in and how should they be investing in? So that's really kind of the key takeaway here. And the second part to this is, if you look at the unregulated exchanges, your Binance, your OKXs out there in the world, they list everything and anything under the sun. And that's really not, that's definitely not our intention. As a regulated exchange, our responsibility is to curate, right? We need to go the extra mile and do the due diligence that is required to be able to list the tokens that are on our platform. What we don't want to do is to list tokens that have bad actors behind it. And the effect is obviously people losing their money, which we are accountable to our customers. I think that's the real clear differentiator here, because the unregulated exchanges really do not have any responsibility to a lot of extent, whereas we are accountable to the public and we're accountable to the regulators. And the third part here to this solution is, we are always achieving to maintain the highest security for customers' information and financial assets. I think this is the most important part as well, because exchanges get hacked, information get leaked, and it happens all the time. And our role is essentially to protect the identity of our customers, to protect the financial assets of our customers, and to work with the regulators to do this in the best possible manner, and to be able to do this across the region as well. The challenge for us is, of course, the technology and the infrastructure is still improving and still developing. And for us, we can only go so far in implementing what is the best solution out there. So in the market, so we would still have to keep up as much as possible while the infrastructure is being developed. So that so that really kind of sums up our role as the gatekeeper in kind of Asia Pacific as a digital asset bank. Thank you.
Thank you very much, Mary. Thank you for that. Can I remind the audience, if they have questions, can post on Q&A or the chat room, please. And we are delighted to have Professor Sanjay joining us. I know it's very late for both of you in Philadelphia, but please go ahead.
Thank you. I'm going to share my screen. Looks like it's go. Somebody give me a thumbs up. All right. Excellent. So thank you so much, Pana, for having me tonight. Of I'm going to go through briefly with an overview of some of the legal implications of the technology, specifically distributed ledger technology and crypto assets. I'm an intellectual property lawyer, focused on technology, innovation, and entrepreneurship. I'm also a law professor at Penn State Dickinson Law School. I'm the chair of the Maker Foundation, which is a part of the, I love all of the DeFi talk earlier, as the chair of Maker, which is a part of the MakerDAO community. So if you're familiar with DAI and MKR. I'm also the founder of the Advantage Evans Academy, who host onboarding or education of marginalized communities to safely onboard to the crypto space. And also have a new course focused on non-fungible tokens in the creativity and collectibles sphere. And I also host a weekly podcast called Tech Intersect, dealing with related topics. One of the wonderful thrills of participating in this conversation today is that my real start in blockchain and crypto education began in Bangkok at Teleki and Gibbons, doing a presentation to lawyers there and throughout the area. And it really was a great launching pad. I focused specifically on many of the intellectual property implications of the technology. And so I wanted to pay homage to the start, which makes it even more of a pleasure to speak to you all tonight. We've heard a lot about Web 3.0, maybe not specifically mentioned, but thinking about the Internet of Value. And I love this quote from Blockchain Revolution from the Tapscotts, and focuses on blockchain as being not just an incorruptible digital ledger of economic transactions, of transactions and balances, certainly can be programmed to record financial transactions, as we know from the first use case, but virtually everything of value. And we really saw when Ethereum came on the scene in 2015, really starting to change the landscape of what was possible. And so I wanted to highlight some of the evolutionary, which seems to be a common theme among presentations, some of the evolution, I should say, of the technology. Obviously, recognizing legacy coins. It's interesting to use the term legacy in the crypto space to not mean legacy finance, but those original coins, certainly Bitcoin, ETH, Litecoin, and then transitioning to stable coins. You've heard quite a bit about that in this presentation and the impact. So we'll certainly see private stable coins, Libra, which is now Diem. I'm familiar with Tether, DAI from the Maker community. USDC has a great deal of market penetration at the moment. And then other probably platform coins as well that may have some pegged characteristics as well that we will continue to see evolve. CBDCs, obviously DeFi, and non-fungible tokens, not just in the creative and the collectible space, but really seeing the tokenization of other real world assets and the power of that unique and verifiable scarcity that has implications far beyond art and collectibles. I think of identity, I think of credentialing, I think of provenance. And so that is very interesting to see the evolution of the ecosystem. And all of these certainly have legal implications. Metaverses are definitely on the rise as well. And so obviously with the wider adoption in not just on the edges, but the wider adoption among the average person around the world, certainly is going to equal greater legal scrutiny. And while most of my presentation focuses on the implications in the United States, we use that as kind of a signal of what might be going on around the world as well. With the full note that there are several countries that are ahead of the United States. And actually the United States has lost a lot of business because of the regulatory uncertainty and people choosing to not deal with you as customers or moving their projects to other environments. I'm also on the Bermuda Global FinTech Advisory Board, and I can see some of the dynamic things going on in the Caribbean. This is a slide that highlights from earlier in the year some of the attempts to bring some legal clarity to cryptocurrencies in the United States, and finally seeing some legislation moving out of subcommittee into committee by being attached to other legislation. It's a great deal of work by the Blockchain Caucus led by Representative Soto and Warren Davidson as well. And so the push to certainty to kind of balance out some of the activities of the new administration that has moved in. And also when we have a changing of the guard, there is that continued learning curve. In some respects, the new chairman of the SEC is certainly no stranger to crypto and blockchain, Gary Gensler. But it's very interesting to watch some of the headlines of the delays around Bitcoin ETFs and the upsurge in other areas for the quote unquote, as the slide shows, the crypto hungry investors who have seen the skyrocketing price of Bitcoin, and kind of a rising tide tends to lift all boats. And we see how the improvement and the acceleration, more than improvement in the space in terms of the price. We've certainly seen the price correction, but even the correction when I began my From Cash to Crypto course last June, Bitcoin, for example, was just below 10,000 equivalent in USD. And now we see where it is playing between 29,000 a couple of days ago, back up, I assume, to about 32, 34. So it's just, I don't know of any other asset class that performs this way. And that's certainly going to be the attention of regulators in a host of ways. We know that there are a lot of the big money from TradFi or traditional finance moving in. Even the exceedingly reluctant JP Morgan not only acknowledged the potential of Bitcoin, but is starting to explore and is already rolling out. This is from April 26th of this year, of Bitcoin funds that we're seeing. Deutsche Bank quietly planning to offer crypto custody, which is something I'll touch on briefly at the end of my remarks as well. We see Morgan Stanley becoming the first US bank to offer Bitcoin funds to its wealthy clients. Their clients don't necessarily want to buy and sell. They want the mitigation of risk by their trusted partners. So they're perfectly happy to stay with the bank, but also to have some exposure in this asset class as well. And so TradFi is scrambling to make sure that they can address the clear customer service issue that now exists. And what we see in the States is President Biden has proposed, this is from June 28th of this year, cryptocurrency information reporting that focuses decidedly on taxes and ensuring that crypto is accounted for by the IRS, to be sure. And so there is what appears to be a clear mandate across agencies and departments to take a closer look at cryptocurrency. So accordingly, we see the Treasury calling for stricter cryptocurrency compliance with the IRS. We know from the 2020 tax return, for the first time at the top of the fold on the first page, the check the box question of whether or not the tax filer has bought, sold, held, otherwise transferred, which is very nebulous. There was some clarification or guidance that came out afterwards that really intended to focus on selling. But the point is well made that the question that was buried, they were burying the lead previously, now moving to the front page. So the mandate is clear. We see Treasury Secretary Yellen has made a number of comments in the space, focusing quite a bit on stablecoins, very concerned with the potential implication and not implications necessarily, but the impact to the ability to control monetary policy and what that will mean over time. So these renewed concerns are trickling down, or it's almost a deluge, I can imagine. And again, the mandate leads me to a legal issues overview that is impacting, obviously, not just the United States, but around the world, particularly as we are dealing with this global evolution and potential revolution. So some areas of law to consider within the jurisdiction, your respective jurisdiction. Obviously, privacy continues to be a major issue and concern, the privacy that is attached to physical money and making sure that the best attributes of privacy are maintained while also balancing against in some way aligning with the need for KYC AML. How do you achieve that balance in the digital space? Regulation, so obviously regulatory bodies. It's interesting to see what happens between regulatory bodies, particularly in a country that has this morass of regulatory agencies and also, quite frankly, the morass of committees on the legislative side and how that all comes together. But I'm focused now on regulators, the SEC, the CFTC, Federal Trade Commission, Treasury, both on the IRS side and FinCEN. An interesting thing that I've been focusing on because there's a bill that has been introduced or shortly will be, I'm not quite sure of the status, but in Pennsylvania, for example, to explore the idea of regulatory sandboxes in the states. There are at least 6 jurisdictions that have welcomed these projects so that you have, instead of the antagonistic nature between a relationship between regulation, and our last speaker spoke to this as well, that we don't want to have this model where there's the umpire and someone engaged in a tennis match, but can we create an environment where the regulator and the innovator are playing doubles? I love that analogy. Side note, I'm actually a former professional tennis player, so I actually really liked that analogy. Also, we will continue to see focus on compliance for the offer and sale of various tokens. This issue that was a hot button issue with the ICO boom and bust and recalibration, we're starting to see that same conversation around the potential securities issues in the NFT space. The taxation, as I've mentioned, is always going to be a major issue. There's been this uptick in focus on crypto because of the latest ransomware issues. Still, the #1 currency used to facilitate illegal activity is the almighty dollar. But that is not to minimize the connection to the ease, at least initially, to engage in ransomware activity with crypto. I happen to think because of the pseudonymous nature, it's a terrible way to actually engage in criminal behavior. And much of that money or value has been recaptured for that very reason. Another hot topic in the legal space involves how to plan for a crypto estate. Because of the difficulty of managing keys and cold storage and seed words, how difficult or almost impossible it would be if someone were to pass away holding crypto, but not have informed and empowered their family to actually access that value. So planning for a crypto estate, perhaps setting up a crypto trustee in the same way that if you're an intellectual property lawyer, and setting up for pour over wills, revocable trusts, or maybe having a special trustee that focuses on crypto assets and having some other trustee managing the other assets in the trust. And then the intellectual property issues, seeing more and more discussion. Layer 1 solutions are generally open source software, but there are a lot of proprietary offshoots of that. And the question becomes the interrelationship of those open source software licenses and how much of anything on layer 2 and beyond might be not exempted, but removed from the possibility of exclusive use or the right to exclude in the case of patents. And so that's been interesting. And also IP pools that are protecting the technology that aren't necessarily exercising ownership and control for the purpose of exclusion, but for the purpose of protection, honoring that cooperative nature that is born out of open source software. Final point is around custody crypto asset services. So that is different from the original ethos around the crypto space and non-custodied solutions. But as I mentioned earlier, there are many who will not want to custody their crypto holdings. And so these custodied crypto asset services are coming to the fore as well. And so with that, and certainly to honor your time, I will pause there, but that is a basic overview. Please reach out to me on Twitter at IPProfEvans and my website, which is proftanyaevans.com or advantageevans.com. And with that, I turn it back to you.
Yes, thank you. Sorry, a long list of things to do, unfortunately. Okay. Last but not least, blockchain technology determines many of the things that we have talked about and future innovation. I go to Pindar in Hong Kong, please. Yes, go ahead. Please go ahead.
Thank you, Pana, and thank you again to China Daily for inviting me here today as other members of the Asia News Network. I just want to notice that we're actually on the hour, and to respect the original schedule, I just want to take a moment to ask for direction. As we know, lost time is never found. What shall we do here?
Go ahead.
Most, I think, of the people who are subscribing. Go ahead.
Yeah.
Okay.
Go ahead.
Well, with your indulgence.
We end at 12:15 in 50 minutes.
Okay.
Okay. If you can,
so
you
thank
can
you
do
so
your
much
10
for
minutes.
the extra time. Okay, I will try. I will try my best. So let me see if I can just share my screen. Do you see this now?
Yes.
Right. So thank you very much again to China Daily and the Asian News Network, Star Media Group, Wharton Alumni Club, and KoreaHerald for inviting me to speak today. In some sense, I've got the easiest thing to do because of all the great speakers. I have a small role, which is to look a little bit beyond the issues of today and talk about what has been called next tech innovations for financial blockchain. What I want to do, though, listening to today's speakers, is really kind of look through the title in terms of next tech. And the point here is that I think throughout today, there was a hidden assumption that we have pretty much a geographical worldview right now. We were like all from different places. I'm from Hong Kong. We've heard people from the United States. Where in the world are you? And I think this next tech innovation is really changing that worldview, primarily from a geographical mindset into a technological mindset, which is predominantly governed by time. So that's really the big takeaway. We kind of ran out the time today, and time is equal for everyone, no matter where you are in the world. So looking through this, I just want to go through this point about time and changing of worldviews, because I think many of the observations today might not arrive in time because the technology, as you may have heard, marches on. So looking at sort of Asia and what might be different from this part of the world, we have about 7 billion people in the world, and half of them, there are more people living inside this white circle in so-called Asia than outside. Again, this primarily has a geographical worldview, and that has been in some sense the assumption, and I think that assumption is wrong. For the last year of designing and working on the Belt and Road infrastructure using blockchain, the governing question, as you may know from about 5 years ago, to the 50 billion machines or devices that are being connected to the internet. So last year was a pivotal year because there's now just over 8 billion IoT devices. So there are now more machines on the internet than there are people. The interesting thing is that in Asia, we will be making these machines. And as you'll hear later, my vision for a wallet in every device has been governed. Now, looking at innovations, we've heard of the traditional central banking, we've heard of these new DeFi technologies, and I would say that we are making a mistake today by looking at sort of linear thinking in really what I see as being an exponential world. And I think that's a fundamental mistake, a fundamental error, primarily because, even if we have CBDCs, and I do believe they're different from Govcoins, and I think that point was made earlier. So what? What is the killer app? Bitcoin may arguably have failed in terms of being a payment rail, but it hasn't failed in terms of its programmability, which I'll come on. And there was a point earlier about how software is going to govern everything. So this mistake about linear thinking in an exponential world is really exemplified by COVID policy responses have been largely linear at best. And if we look at DeFi, for example, as was mentioned earlier, we're seeing fist upon fist upon fist of innovations that seem to be compounding at a faster and faster rate. So this notion of geographic regulation by the 193 countries in the world is of a completely different scale from the 70,000 networks that make up the internet, or the 11,000 different cryptocurrencies that are in existence today, vis-a-vis the 180 fiat currencies in circulation by the 193 UN nations. So what problem are we actually solving? And if we solve it in time, will that make any difference whatsoever? And this machine-to-machine world, where the network is of importance, and where we have economic participants, not being humans, not being companies per se, but also algorithms and AIs, they're going to be the new participants in our economy. So the Belt and Road provides a very unique opportunity to think again, what is the future economy that we really need to build for, and how are we going to maximize the opportunity? So earlier today, we talked about sort of KYC as being the existing constraint or existing manner to address anti-terrorist financing within the existing use of blockchain technologies in financial industries. I'm not actually concerned about KYC, because I think the KYM, in terms of know your machine, in terms of the 50 billion devices that are coming, is actually a much more larger opportunity because of these networks of machines and robots that will be economic participants. So this new assumption, in a sense, of having automation through software, through AIs, through DAOs, is going to change market structures, and there will be new winners and losers. So in some sense, thinking about central banking in a decentralized world doesn't quite address the issue, because it assumes the two participants are companies, legal persons, and humans being natural persons. And I think there's a third, which is, again, these machines, these algorithms that are basically coming, or actually, in fact, already here. You know very well that within the Samsung S10, there's a Bitcoin wallet or crypto wallet facility. HTC Exodus also has this. So these wallets are already in the phones themselves. So taking that the next step further, the vision I've been talking about for the last few years has been very simply, what happens if in our economies, when there's a wallet in every device? Not a wallet in every phone, not a wallet for every company, not a wallet for every person, but a wallet for the 50 billion devices. And that's a really different world in which to think about the challenges of regulation, the challenges of monetary policy, more interestingly, the challenges of fiscal policy. And the Belt and Road has been a wonderful opportunity to think from a wide slate. The key insight here is, as was mentioned earlier, that this money is programmed. Software is going to eat the world, and so follow the smart money. The smart money in this case is really going to be smart. It's actually going to be programmable, and when it's programmable, what's very interesting is that the level of automation and frictionless nature of happening in milliseconds, not hours, not days, really challenges us to think about what actually makes sense. Does it make sense to charge interest, for example, when you're talking about interest that accumulates in milliseconds as opposed to months or monthly interest rate or hourly interest rate? The time scales really does change. The interesting takeaway from the work on the Belt and Road blockchain and thinking about the Greater Bay Area is that these fundamental machine-to-machine networks need to be halal. And for those of you who follow Islamic financial principles and the very algorithmic nature of the contracts, Madaraka Musharaka, those contracts which can be programmed, is that there is no riba, there is no interest, primarily because in some sense, it makes no sense to have that for the machine-to-machine economy, because keeping track of it, in some sense, the overhead is so large. So what does this do? What does this do? It changes our assumption of, in fact, money itself. You know, in Hong Kong, we have an assumption, which is time is money. And what we've seen from Bitcoin is, in fact, that a data structure, the blockchain, is, in fact, could be viewed as some form of money. So the nature of money in and of itself is changing. And I think the real challenge here is to pivot our thinking from a geographic worldview of where we are in the world to this issue of technological worldview. And that technological worldview is fundamentally different because laws, as Professor Evans has made, and for her being in the United States, still has a very much a geographical assumption. Whereas technology and these machine-to-machine networks has a temporal assumption. So it doesn't matter where you are in the world. It makes no difference where we are today on this video call, as long as we synchronized in time. In other words, when something occurred. Because blockchains preserve this ordinal nature, that's a very interesting property. So to conclude, the key insight here in looking at regulation and all the new things is that, yes, we like law and order, but unfortunately, laws have borders. This Westphalian geographic worldview is probably the wrong starting point. What is the right starting point is that we have to observe that the property that we want is no one is above the law, but we also have to recognize that no nation is below mathematics. And so the reason why blockchain and cryptocurrencies and crypto everything is in some sense important is because it does not rely on the law and the organized or monopoly of violence behind it in order for it to be enforced. It is enforced by mathematics. And so it's this mathematic temporal view that I think is really we need to consider for the machine-to-machine economy, which I believe has to follow Islamic financial principles. We have to have Sharia compliant smart contracts. And there we have a real opportunity for thus in GMT 8 or GMT 6+2 or Asia, as we used to call it, for in fact thinking and taking a leadership role for this new form of economy. Thank you very much.
Thank you. In a very futuristic world, may I come to ask Sanjay to ask a few questions, please?
Yep, sure. I think maybe the first question could be for Marcus first. So I've seen that like for Zipmex itself, like you guys have been fully compliant in all the jurisdiction you are at, right? So my main question is, what are the main challenges in dealing with different jurisdiction? And because I've seen like I think at the moment, right, like we have seen a lot of regulation witch hunt on couple of trading platform, I would say.
Yeah, and so thanks for that question, Sanjay. So I think that there are quite a number of challenges. So I guess the first one is the uncertainty, because as I mentioned in my presentation, that this whole industry is extremely new, and the regulators, from an education standpoint, need to school up as fast as possible, and require that kind of knowledge sharing center, which I think at the moment is lacking. And so because they're so far behind in trying to understand to understand very quickly, it's uncertain where their posturing is going to happen, right? In terms of how they're going to be dealing with regulation in our specific industry. So that the first one is really kind of the uncertainty. The second is, as we are regulated across different jurisdictions, as I mentioned, every jurisdiction has, every regulator in each jurisdiction has its own focus on how they want to regulate or what their kind of priorities are, right? And for us, that challenge is how do we build a system, right, to incorporate effectively the best in class from all these different jurisdictions, right, into one. Because that's where I think we can be scalable, and the benefit to that is we can apply what the priorities are for the other regulators and try to firstly implement it on our own platform, and secondly, consult and collaborate with each of the respective regulators in each of these countries, right, to form, a so-called a best in market regulatory standpoint or requirement, right? So that's kind of the second challenges. And the third one really is the bureaucracy, of course, with dealing with regulators and, trying to shift their mindset from a legacy thinking of how they traditionally have regulated the stock exchange or the stock market, and then, kind of moving away from that and helping them to see how they should pivot their regulation to regulating our digital asset industry. And that mindset or the shift in mindset is incredibly challenging, and also it's not a overnight success. It takes, for us, it's taken 2 years. It will be many years to come as well, right? And I think it's also a function of the generation gap, right? Typically with these regulators, there is a generation gap to the actual customers that we see on our platform, which are typically millennials or even younger, right? That's where the bulk of it is. But most of the regulators are baby boomers, for instance, right? So there is that huge kind of generation gap. So these are kind of really the three key challenges that we have.
Yes, can I ask the two professors, Professor Werbach and Tonya, the students that you are teaching now, studying crypto and so on, are they very different breed to the normal MBA students? Maybe this is a bit more down to earth, unrelated question.
No, it's the same thing. This is the future, and people are interested in the future and either seeing it as something that they want to go into as a career or to understand its potential. That's what attracts people to this area. So I wouldn't say that that they're different from the other students that I see.
Okay, Tonya, in the legal profession, similarly.
Well, the students, I've created the blockchain, cryptocurrency, and law online certificate program. And so it was interesting to see professionals who wanted to understand the legal implications, even if they weren't lawyers. For my law students, I've gone from when I first started teaching this in 2018, which is a blockchain, cryptocurrency, and law course, from 6-8 really excited and enthusiastic students, most of whom just wanted general information. A few of them ultimately go into the space. The great majority just want to know how to spot the legal issues. I just checked my numbers this evening, and I'm oversubscribed with 25 students and 2 on a waiting list. And so while the students are, I wouldn't count them as different, I think that this is on their radar. And increasingly so, Professor Werbach, I know that you have experienced that as well on the MBA side. So for law students, there's a great deal of interest in understanding the legal issues.
Yes, Stephane, a big plus news today that Elon Musk spoke at the B Word online conference, saying that SpaceX will be financed by crypto, and then Tesla will resume crypto, accepting crypto very soon. And for you here in Thailand, anchor also on the big names like Sanjay property, which now accepting crypto to buy condominiums. So the market very much is moving in favor and embracing this in the scale that we was unimaginable maybe 6 months ago.
Yeah, that's right. I can't remember who said that 2020 was the pivotal year. I tend to agree. Before that, it was give or take, is crypto is going to be relevant over the long term? But I think that when you see the main player moving in, and to be fair, people accepting Bitcoin will convert Bitcoin to fiat right away. So it is more of a gimmick, but it's an important gimmick. I think that Visa, PayPal, Tesla, people, JP Morgan, Jamie Dimon 4 years ago was saying Bitcoin, anybody trading Bitcoin on my desk should be fired. They're going to open high net worth ETF for the at JP Morgan. I think that we are past the point of no return. I think that it's a demand-driven adoption. I think we're going to have to shake the tree and see how many monkeys are left hanging, but it's part of the system. What we see right now, we see great minds getting together to do things right. And I hope that 2020 was pivotal year, and I hope that 2021 will be the year where regulator put a line in the sand and finally decide who can be a good actor and who should be prohibited from operating into this industry.
Yes. Sanjay, any final question?
Maybe a final question might revolve around the latest, like I watched a session yesterday as well where Elon Musk talked. So my question might be around where, like Stephane had mentioned, right? Like the Pandora box has been opened. So maybe my question is to any of the panelists here. So regarding like the corporate treasury of keeping the crypto asset as on their book, like what are your thoughts on that? What are the challenges? And are we going to see more of that as well? Yeah.
I mean, I may say an advice to Elon. If he's going to accept Bitcoin for his Tesla car, he should buy puts on Bitcoin. He shouldn't buy treasury on Bitcoin because effectively it's compounding risk right now. But guess what? He made more money trading Bitcoin than selling cars. So that's probably what he's looking at.
Yes. Pindar?
The issue of how treasuries manage crypto assets fundamentally revolves around key management of the cryptographic key material. So we won't have time to discuss this today, but in the Begin Blockchain Governance Initiative Network, we supplied some information to the Financial Action Task Force. These processes need to be evolved if we're going to meld the two worlds of legal accountability with cryptographic certainty. So what will be very interesting is that over time, how corporate company registries have procedures for managing the keys, because it all revolves around managing the cryptographic key material. If there's consensus around that and we have legal recourse to that, then I think we have something interesting. So please look at begin.global.net. There's a working group there. I'll put it into the chat.
Thank you. Thank you. I think we ran out of time, and I would like to thank you, everyone, particularly those from the United States who stay so late. You know, John, Stephane, and the two professors who had to leave early, and Pindar also, who not so well, not 100%, but be with us, and would like to thank the Star, Malaysia, Korea Herald, the investor, the Wharton Alumni Club of Thailand, and the Story Thailand to help all this make this webinar possible. And thank you for, I think everybody has helped. I think we learned a lot today, and you put up a good show in a short time. I think we have a quick 2 hours understanding of what's going on in the financial world, a revolution, I'm sure, and the rise, like the rise of the Jedi. Okay, I hope to see you all very soon. Anything I can do, please let me know. And thank you for the audience. We had a peak at 253, and most of them have stayed with us. And we're back. We're back soon. Thank you very much. Good night.
Thank you, everyone.
Thank you. Sanjay, thank you. Thank you.
And may the force be with you.
Very much. Thank you.
See you, John. Take care.
Very good. Very good. Yes, see you later. Pindar, take a good rest. John, thank you. Thank you. Nelson, I don't see you, but thank you for very good comment. สันเจขอบคุณฮะได้
ครับขอบคุณมากครับพี่ปานะ
ได้ขอบคุณฮะขับเฮาส์อาจจะน้อยไม่ค่อยอาจจะไม่ค่อยเวิร์กนะโอเคได้ thank you and there are some audience are leaving thank you ขอบคุณ thank you ออกได้ยัง